This webinar will be recorded and will be available here in about next day or two online, and you'll be able to see it there. Okay, so again, let me just do, I'm always paranoid that GoToWebinar has done something wrong, but just to verify, the initial slide is up. If you don't mind just typing in a quick S for slide, that'd be great. Thank you very much. All right, threw you a curveball. I asked you for a yes before, and now I'm asking you for an S. So, okay, let's go ahead and start things off tonight. Now, the goal here is to talk about low-risk trade entries, and believe it or not, there are some strategies out there, and I'm going to show you some very powerful ones tonight that are designed for low-risk trade entry, and these are great to add on to a lot of different other approaches to trading the markets. For example, if you have a strong daily setup strategy that you currently use, then what I'd recommend you do is check out some of the tick charts possibly and drill down to maybe 250 tick to 500 tick depending on the market that you're trading, but drill down and use some of the strategies I'm showing you tonight to time your entry. So use the dailies for the setups and then drill down to intraday, again, 250, 500, 100 tick charts to time your entry in the markets, and you'd be surprised how close you can get to the turning points, the very short-term ebb and flow turning points in the markets that get you in at extraordinarily low risk, especially if you end up being right about the move, or if you're not wrong about the move. A lot of the strategies we're talking about tonight are going to be great to really reduce your risk and put you in the driver's seat with your trading. Now, for those of you who don't know who I am, I've been in the hedge fund business for about 20 years now. I've been blessed to be a part of some great teams. We've won 3 national awards, 2 of those being Star Searches for top hedge fund managers, and I have been through some roller coasters. I've had some great times with the hedge fund world. We've had some challenging times as well. I've had to close one fund down when long-term directional volatility really dried up in our space. But trading can be challenging, but it's definitely something that you can succeed at if you use discipline and and really spend the time, invest the time to come up with a strong strategy that has the propensity to generate fairly consistent returns. And so there are traders doing that consistently out there, and hedge fund managers doing the same. So I encourage you to stay with it if you have a passion for trading. But I will tell you that if you're part-time in this and or have an attitude that's more nonchalant, it's a lot more challenging to be successful over time. So you definitely have to put in the hours like anything else, and you can obviously achieve your goals, I believe, longer term. Now, the one thing I'll say too, as far as my experience, I'm probably most noted for coming up with the value charts concept. I'll show you that tonight, and it was really a need that was out there that I felt was not being addressed by the current tools in the markets. That is one of my favorite tools that I use to trade, and our team uses to trade here at valuecharts.com, obviously. And we do that for a reason, because it's extremely powerful and it can do things that other tools just are not capable of doing. So I've published a book called Dynamic Trading Indicators with John Wiley & Sons Marketplace Series, and I've been a national and international speaker with Bloomberg and Money Show and whatnot. So that's enough about me. Let's move on to the good stuff. Now, before we get started, trading or investing carries a high level of risk. It is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. Now, I do not want you to trade with money that you cannot afford to lose. That's my opinion. I've seen a lot of good folks go into the markets, and the statistics don't lie. Most people lose trading the market, so make sure you're trading with money that you can afford to lose. Now, I'm not saying you necessarily will lose your money, but I am saying that it makes it a lot harder if you're trading with money that you actually need badly, or you need for some sort of future planning, and you cannot afford to lose that money. So I don't recommend you trade with that money per se. Now, the other thing too, I'm going to show you trading examples, but no hypothetical dollar results or equity curves tonight. But it's important to understand when you look at trading strategy results that they have certain limitations, unlike actual performance records, which also have limitations, mind you. Simulated results do not represent actual trading. So past performance is not necessarily indicative of future results. Now, if you're new to trading, or if you come from the fundamental analysis camp, I'll tell you that traders can learn to read supply and demand forces in the markets by analyzing charts with the correct tools. So this is something that a lot of traders don't really understand, but you can do that. You can actually learn to read the character of a market, and at certain points throughout the day, you can become so proficient in analyzing the markets that you're going to see great buying and selling opportunities jump off the charts at you. Learning to identify low-risk entries can radically transform a trader's results. Now, there's an ongoing debate out there. Yes, John, this is recorded, by the way. Ongoing debate out there as to what's more important, the entry or the exit. Now, it's almost like arguing what blade of the scissors is more important, but not necessarily, and I'll tell you why. I believe that entries are a lot more critical than exits. Now, both are important, but if you master low trade entries and you're able to hone your skills down where you can identify low-risk trade entries, then you have a much greater advantage over those traders who don't. And it's really almost like contract law. If you are able to negotiate a great contract agreement on the front end, then it gives you a lot of flexibility and freedom to, accomplish what you want to accomplish. And initiating a trade is the same way. If you buy into a market undervalued and you time it correctly and you have the momentum confirmation, or if you have a pattern confirmation of some kind that has a probability for success, then you put yourself in a situation with much higher odds of a trade achieving unrealized losses close to trade inception. I'm sorry, unrealized gains, excuse me, close to trade inception. And that's the goal. We want to buy into a market, and in a perfect world, we want our position to start turning profitable as quickly as possible after trade inception. So I'm a huge believer in mastering skills related to trade entry, and I believe that you're certainly capable, any trader can be capable of honing those skills down and giving themselves a tremendous edge. Now, this does require the right tools, okay? It's like anything else in life. I mean, you ask a baseball player if they have a preference for bats. Absolutely. In fact, it's down to a science. Not too long ago, actually, I was in a softball league for fun, and we played the Catholic Church, and those guys were known for just killing it, hitting tons of home runs. And what they ended up doing was buying these triple-walled baseball bats that had a lot of spring to them. So these guys were big guys anyways, but they would hit the ball with these triple-walled bats, and literally half the team would be hitting home runs. They would just absolutely destroy every other team they played, it seemed like. So it does make a difference. Technology can make a huge difference. In fact, so many people are hitting home runs with these triple-walled bats, they actually outlawed them, I think, for a period of time and didn't allow people to use them because it gave people too much of an unfair advantage. Now, trading tools are the same way. Trading tools can make a tremendous difference in how you're able to detect great trading opportunities. I've actually seen a lot of, or I should say a lot, but some presentations or YouTube videos out there where a trader will say that indicators are not important and things like that. Now, you can learn to trade a market using price action. I don't dispute that, but I will tell you that it's almost like a race car driver can learn to listen to the engine as well. But why not have the RPM gauge? Why not have the oil pressure gauge and other things as well? So a lot of the tools I'm going to show you are going to communicate powerful information that, in my opinion, is extremely difficult to infer or see without the tools, if not impossible. So I'm a huge believer in having the right tools and in finding strategic entry points. Now, the three components of technical analysis, let me see if I can bring up my pen here, are essentially cost as being number one, and all cost is a traditional price chart. It's what we know as price. So if you look at an open, high, low, close chart or a candlestick chart or a tick chart or that type of chart or a line on a close chart, those are all what I determine or term as cost charts. And what that's doing is plotting the history of cost, if you will, for a market. So how much does it cost to buy a share of Apple stock? What is it, $95 and change? So that is the cost of the market, and the cost chart is a very powerful tool in showing us the direction of the short-term, near-term, and longer-term trends, and also can be very powerful for showing us historical price ranges and support and resistance levels and price patterns as well. So the cost charts are really considered to be the most widely used market analysis tool in the world, and are certainly what I would consider to be one of the primary components of technical analysis. Now, the second one is momentum. And momentum tools have been around for many decades, and there's a lot of them out there. And this has to do with the velocity of price. And I would say the magnitude of price going in one direction and velocity, depending on the volume, can increase the importance, if you will, or validation of momentum. But it's really the velocity of price going in a certain direction. And I'll show you a tool that's great for measuring momentum, but there's quite a few of them out there, and I'm not sure I believe I have my favorite momentum tool, but there are a lot of decent momentum tools out there that are usually standard on trading platforms. Now, last but not least, my favorite of the three components of technical analysis is value. Okay, now this is something, interestingly enough, that a lot of traders have a difficult time getting their minds around. Now, if you think about making any type of a meaningful purchase outside of the markets, we always look at value. That's a critical part of our buying decisions. For example, looking at a free market example with used cars, if I go out and buy a used, call it convertible Mercedes, and I have no idea what it's worth, what I would do is go look at the Kelley Blue Book Buyer's Guide or the Edmunds Buyer's Guide and get some sort of an idea of what fair value is for that market. So value, a value reference, and I call this an objective value reference, is critical. Now, it's interesting, when I was an engineering student back in college, I noted that there was no Kelley Blue Book for the markets, and there was no appraiser who could come out and tell me what a stock or a futures contract or forex contract was worth. But I knew that objective value was a very real consideration. So that's what led me to design and develop and research what we now know as value charts as a tool to communicate objective market valuation. But these three components, or these three aspects of technical analysis, in my opinion, give you a very comprehensive picture of what a market's doing. Now, look at cost, for example. If you say, well, Mark, I want to use candlestick chart patterns. Great. Those are cost patterns, okay, and can be very helpful. Or I want to use, Elliott wave theory. Great. Those are also cost patterns. So there's lots of different types of tools you can use out there to complement these three aspects. But if you have these three aspects of technical analysis on your screen, you really are getting the full picture of what a market's doing. Now, again, just for review here, let's look at my pen. Okay, just review. Traditional price charts display cost, open, high, low, close, candlestick line charts. Momentum indicators, and there's a lot of them out there, MACD and many others, display momentum or communicate momentum. Value charts is the tool that I developed back in college as an engineering student, designed to display or communicate objective market valuation. Now, when most traders or investors think of value, they think of what I'll call subjective market valuation, and that's the opinion of somebody on the outside of what a market's worth. That is not what I'm talking about here. We are interested in what I'll call objective market valuation. What do active buyers and sellers in a particular market, what do they believe is fair value? What do they believe is overvalued? What do they believe is undervalued? And that's what value charts are designed to determine and measure. So that's these three tools together, again, are what I use to find strategic entries. Now, if value references are so important outside of the markets, why are they not just as important when trading stocks, options, futures, and forex? I'll tell you, one of my beliefs is the reasons why so many new traders fail to make money in the markets is because they're buying blind value. They just go in, they say, okay, they have a long-term opinion, they read a some sort of an analysis for some sort of market out there, and then they go and randomly buy. Now, let me tell you what an example of doing that outside of the market would be like. If you, for example, decided to buy, or I decided to buy a convertible Mercedes. I just said, oh, great, this is the model I want, a CLK 500 AMG, okay? And I go out and I find one at the first car lot out there, and I say, great, that's what I want. I'm going to go ahead and buy it. Now, none of us would ever do that. That's a recipe for getting ripped off and overpaying for an asset, right? Because we would probably be paying over what the objective value references like Kelley Blue Book would consider to be fair value. My point here is when you think about how important objective value is for appraising a house or looking up a used car value outside of the markets, I'm here to tell you it's that important, if not more important, when trading stocks, futures, options, and Forex. So if you're blind to value, then you're taking a huge risk in possibly overpaying or getting ripped off, just like you would outside the markets. Now, objective value references for real estate, they use appraisals or appraisers to come in and give them that objective value reference. Used car markets uses Kelley Blue Book or Edmunds. Stocks, bonds, futures, and Forex historically have not had that objective value reference. Now they do with value charts. Now let's get on to strategic trade entries. What do I mean by that? Entering each trade with the goal of achieving unrealized profits as quickly as possible after trade inception, and entering each trade with the goal of minimizing risk. Okay, here's what, and I'll show you, actually, let me move on to another slide here, and I'll show you what happens when we talk about the different types of marketplaces here. Learning strategic trade entry is perhaps the most powerful skill in trading. Again, I emphasize entries. If you get your entries right, you have a lot of flexibility, even if you're ultimately wrong in the direction of the market. Once you are in the money with a trade, you are in the driver's seat. So once you're in the money, you have a degree of separation. You can actually put a break-even stop in on your position, and for the most part, your position is safe. So you have a no-lose proposition. Now, I'll hedge that by saying there's no such thing. The markets can gap through our stops on rare occasion, but day in and day out, generally speaking, assuming you're not trading before some sort of major report, economic report or crop report out there, generally speaking, a break-even stop is a position where you do not have any risk, because generally speaking, the market's going to trade through it and execute you at or very close to where you have your stop. So it opens up a lot of interesting and exciting opportunities for us when we learn to enter markets strategically. Now, learning to read value and momentum clues in charts in order to forecast price direction is a powerful skill. And I'm going to show you some ways to do that today. And I've taken recent market examples over the past couple of days, and I'll show you how well it's been working. Now, introducing value charts. I've talked about value charts. What are value charts? Value charts are designed to communicate the objective valuation for any market and time frame combination. They are not communicating information about any other market than the market you're applying the value charts to. So if you have value charts applied to Apple, that's what it's analyzing. It's taking an algorithm and analyzing where buyers have bought and sellers have sold, in other words, historical transactional price activity, in order to generate a model of what market participants, active market participants, consider to be fair value, overvalued, and undervalued. So it's almost like a super Kelley Blue Book. Almost like if you had the ability to go out and look at a car and you typed in the price of Kelley Blue Book, and all of a sudden they would send you back a reading. This is overvalued. This is extremely overvalued, this price. Or this price is excellent. It's very undervalued. Or this price is fair value. So if there's a way for them to do that, that's like what value charts can do. Because value charts not only define fair value, but they go a step further and actually identify or they actually define overvalued and undervalued states in the market as well. Now, let's talk about value for a second. So we don't really fully understand value through our purchases outside of the market to the extent that we will with value charts. And let me explain some of the characteristics of objective value. Now, first and foremost, value is time dependent. What does that mean? Well, it means that it's possible for a market to be short-term undervalued and long-term overvalued. So don't be bothered by that. Every market in the world operates that way. For example, The real estate market in Florida after 2005 had a substantial correction over the next couple of years. And that was it coming from short and long-term overvalued, and then short-term markets started to stabilize. So shorter term, several 2 or 3 year property flippers started to look at the market and say, okay, these prices are now fair in my mind. Well, if you look at the longer-term institutional investors, they were still looking at like 50-year real estate cycles, and many of them thought the market was still way overvalued. So every single time frame has a unique valuation, and we'll look at some ways to measure those tonight. Value is best described by active market participants, and this is one of the reasons why subjective market valuation, which is what we think of value historically in the markets, this is one of the reasons why subjective market valuation has such a bad reputation. In fact, I was talking to a publisher at John Wiley & Sons recently, or it was actually a couple months ago, and she was telling me that they have great difficulty publishing books on value because it's subjective value. It's what are people's opinions about the market, and 9 times out of 10, it's an analyst who's stating an opinion about the market. They may or may not be influenced by side deals going on between that company and their analysis, and 9 out of 10 times they're not even trading that market. So that type of analysis, subjective market analysis, really has to do with the skill level of the person giving the opinion. If it's somebody like Warren Buffett, we may pay closer attention. If it's a new analyst in New York who has other motives for delivering a very positive, outlook or, undervalued picture for the market, those are wildly inaccurate many times. What we're talking about here is objective market valuation analyzed by what buyers have paid and sellers have sold for, and that's what Kelley Blue Book uses, and that's what appraisers use to give you the best picture of what fair value is for a market. Now, next, value is best described as a price continuum. Now, this will throw you a little, if you're new to it, this will make you think. Now, Kelley Blue Book gives us one value price for fair value, and that's what we think of. You say, what is the fair value for an asset? We think of somebody giving us one price, but in actuality, my research has really shown me that it's much more accurate to describe fair value as a price range, where the majority of buyers and sellers have transacted business. So instead of just one price, it's a range, fair value range, where we'll call it the middle part of the bell curve. 68% or so of traders or people, active participants in the market, agree that prices are fair. All right. Now, beyond that, you also have overvalued and undervalued price levels as well. What that gives you, and I'll show you this in a second, is a bell curve looking continuum of market valuation, which can be a very powerful tool. Fair value, again, I just talked about this, is best described as a price range, not a single price level. Value is defined as time at price. What does that mean? Well, I'll get to a question here in just a second here, but what that means is that, let's say in Florida, you had people who had lived there for many years. When I was down there in 2005, and really the run-up all the way from 2000 to 2005, we started seeing these oceanfront properties start to zoom up in value or price. And the people who had been there for a long time thought they were really expensive and they seemed overvalued. But as time went by, even at those higher price levels, those became more widely accepted as fair value. So a house on a canal which sold for, call it $150,000 in 1999, in 2005 it might sell for $500,000, or 2004. So it doubled in price. People who had been living there for a long time just couldn't accept it for a while, and then over time they started to realize that was the new market. Those were the new prices. And that became fair value for the shorter term property investors. So value at time, or value is defined as time at price. Okay. Now value, last but not least, can be measured. So it's important to understand that objective market valuation can actually be measured. And that's really the most exciting news, because we can use this as a very powerful tool to help us time our trade entries and exits. Now, an overvalued market can become more overvalued. Understand that. So just because in the markets, in stocks, futures, and Forex and options, just because a market is overvalued does not necessarily always mean that the market has to come back down to fair value. It could be experiencing what we call a value migration. An undervalued, point 2 here, undervalued market can become more undervalued, especially like in a flash crash, which is a very rare occurrence, but you need to understand there are times where you'll have a strong value migration in one way or the other with prices, and they don't necessarily have to come back down. That's it's a fact about the markets. It's a fact about market valuation as well. Now, there's two states, if you will, that value goes through. The first one is what we'll call value migration. It's when a market starts hanging out in the overvalued zones and prices start moving up and up and up and up and up. So that's when you start to see a powerful movement or migration psychology in the markets, or a market where traders start to view that market as being undervalued, or a strong momentum, if you will, to the upside, a trend to the upside. So that's what we call value migration. Now, the other aspect, which is much more common, is what we call a value reversion. So if a market shoots up into overvalued and then stalls out and comes back down into fair value, that's what we're going to look to take advantage of as traders. And this is really the norm. This is what happens most of the time in the markets. But it's important to understand that you see a lot of value migration and you see a lot of value reversion. And we're interested in studying and identifying value reversion in the context of other properties of price and of momentum, and combining all of those together to find highly strategic places in the markets. Okay, we have a question. How about value based on price earnings ratio? That is a fundamental measure that you can, if you're good at using that, that can be an input, to help you forecast prices. This has nothing to do with that, okay? So PE ratio is a state, if you will, of the stock, price earnings, obviously, of the stock, and that can complement what I'm talking about. But what I'm talking about today is directly derived from analyzing the price action between buyers and sellers, okay? Objective market valuation. A lot of words on slide here. Will we see some examples? Yes, you will. We are going to see some slide and trade examples here in just a second. So go into that. That's why I'm trying to hurry through this other stuff. Now, here's a picture of a value chart. Let me show you what this looks like. Traditional chart here on top. This is what we all know. The units are based in dollars per share. So this is nothing new. Open, high, low, close chart on the top. Now, if I took let me go ahead and erase this. If I took call it a floating axis here. Now notice that all cost charts or price charts, as we know them, they all are plotted with respect to absolute zero. So for example, this stock right here is trading at $65 a share over zero. Okay. Now value is a different animal. Value is a relative measure. We're interested in doing that. So if I have this red, we'll call it floating value axis here, following price along, this could be used to give us a very primitive definition of market valuation. Okay, moving average of median price levels. All right, now if I took this moving line here that I'm showing you on the chart, just kind of roughly drawn, if I drew that in a straight fashion, made that linear, that becomes the zero line to my value chart at the bottom. And forgive me, I'm not drawing a perfectly straight line here, but assume that yellow or the red line on the bottom is perfectly straight. That becomes your primitive definition of market valuation. Now, what we're really interested in, though, is the deviations away from that. We can learn a lot about that, and that communicates powerful information. Now, you'll notice that there's total 3 colors and 5 zones here on the bottom. Let me go ahead and just briefly touch on those. So these are the 5 valuation zones. Top one, top red, is significantly overvalued. Top yellow is moderately overvalued. The middle green is fair value. Bottom yellow, moderately undervalued. Bottom red, significantly undervalued. Okay, so okay, is this focused on introducing value charts tools? I already have them. Yeah, so Dan, I'm going to show you what's been working with value charts here and getting to slides. So no, this is just a quick review for those who are new to value charts, and I'm going to try to move on here. So let's go ahead and move on. Again, you'll see the slide here with the 5 valuation zones. Very easy to understand how value charts are broken down. So 5 valuation zones. These are based on statistics. The center green zone, fair value, is plus or minus 1 standard deviation above or below that moving floating value axis. Plus 1 to plus 2 standard deviations is the upper yellow, moderately overvalued. Plus 2 and beyond is what we'll call significantly overvalued. Same convention on the downside. The bottom, yellow, moderately undervalued. That's -1 to -2 standard deviations. Below that is plus or -2 standard deviations, and below, significantly undervalued. If you don't know anything about statistics, you don't have to care at all about this, okay? It's almost like none of us really know the fuel-to-air ratio that powers our internal combustion engines in our cars. So you don't have to know the statistics. All you have to know is there's 3 colors, 5 primary valuation zones, and I'm going to show you how these are used to trade. Now, quickly here, this tool to the left again, I just introduced. This is called the, let me get a easier color to see. This is our value charts price window, and it's using what we'll call a dynamic volatility unit. It's a different unit than markets use. It's a unit that adapts to changing volatility. It's very important to have that, otherwise value charts don't work. On the right-hand side here, this is the distribution of the value chart bars in and among these dynamic volatility units. This gives us the ability, using this tool called the price action profile, to determine the degree that a market is overvalued or undervalued. Just brief introduction. If you don't understand that, don't worry about it. I go into this in more details in future webinars, but I just want you to know these are complementary tools. All you really need is the value charts window over here to the left, but the price action profile is out there as well, and it's another tool in value charts. Now let me show you really quickly here the dynamic volatility units. These are actually stated in terms of the S&P units in the top. And this is not how they're normally displayed with the value chart, but this shows you the dramatic adjustments or the ability to adapt to changing market volatility here in the dynamic volatility units in the bottom. So just remember that your value charts are adapting to increasing market volatility. They expand dramatically, and if it's a slower market, they contract. So that's how they're able to deliver or communicate reference levels that we can use to identify strategic low-risk entry points. And again, with commodity markets sometimes building up into a huge bull market that has a crescendo effect, you can see that the dynamic volatility units have to start really increasing their spacing, if you will, in order to account for dramatically increasing market volatility. From left to right here, you can see this this increase. Now this is not a tool here I'm showing you with the color zones down there. This is a value chart. Simply, it's the value chart zones displayed in normal prices, just to show you the adaptive nature of value charts bars. I am taking questions, Jim, so this is great stuff for day trading. Let's get over to this. Again, very quickly here, this is a value charts price, master value charts window here. You have the normal chart, the value charts below it, and the dynamic trading, the price action profile here to the right. Again, just showing you one way of using that. Now, let me fly through this so we can actually get to the good stuff. How do we use this to trade? Value charts validation. How do we know value charts work? Well, we actually went out there and asked several top PhDs in the top academic institutions to evaluate whether value charts are effective at defining market valuation. Here's what they had to say. Value charts demonstrate a remarkable ability to define market valuation through dramatically different volatility conditions contained in 30 years of S&P 500 market data. So value charts were thoroughly tested by a PhD from University of Michigan, UCLA, and the third one from University of Pennsylvania, Wharton, to determine if they are actually working in defining objective market valuation. This is the second study, and this again reinforces the idea that value charts are effective. Now, having said that, you still need to learn how they work. Okay, I'm going to fly through this. Okay, remember non-centralized versus centralized markets. Okay, I'm not going to spend really any other time on this other than showing you that in markets outside of the stock market per se, we shop differently. Okay, we look at one point in time, we shop geographically for the best value. So we may visit multiple locations to find an undervalued car, or look at several houses to find the undervalued house. All right. In the markets, it's different. We actually shop for value over time. And this is what we call timing the markets. Right? When people say you can't time the markets, what they're really telling you is that they have no idea how to determine the valuation of a market. But there is a way to do that. And now that we have that, our goal is to buy undervalued when we start to see the price discovery process swing undervalued, and we want to sell overvalued. Okay, now these tools are used in conjunction with other tools, but that at the end of the day is what we're after. Now, here's what we have a natural tendency to do. This is what kills so many traders, is instead of trading on value, new traders especially trade on emotion. So when they see the market start to zip up in price, they start to say, okay, I'm going to miss out, so I better jump in. That's where greed kicks in, and this is usually an overvalued state. Or if they start seeing their position selling off, they're starting to lose money, fear kicks in, and then they end up dumping it undervalued. So doing the exact opposite of what we want to do. We want to buy undervalued and sell overvalued, but it's extremely difficult to do if you have no idea how to define value charts or market valuation. So let's go ahead and move on. Now, I'm going to leave this up just for a second. For those of you who want to watch the recording, you can later on. People say, what tools do you like to use to determine your longer-term outlook, okay, or setups or signals? And today I'm going to mainly focus on finding intraday signals that you can use in conjunction with longer-term setups and longer-term outlooks. So when I say outlook, it's really having to do with the trend of a market. So what tools can I use for outlooks? I use value charts, MQ momentum, MQ cycle finder, and setups are value charts. I use MQ momentum, MQ cycle finder. You can use other tools out there. There's other cycle tools. There's other momentum tools like MACD, and then I use value candles as well. That's a combination of value charts and candlestick charting. Now for signals, this is what we're talking about in today's presentation. I'm going to jump over to charts next. I like to use value charts, MQ momentum, MQ cycle finder, value candles, MQ trend, value flags, and parabolic SAR. All right. Now don't worry about not understanding what these are, because I'm going to show you a chart and you're going to see these on a chart. Okay. Under overvalued stock scanner. Yeah, Mike, we're going to work on a stock scanner with that, different, excuse me, there's different platforms out there, and they're all different. So depending on what they allow you to do, it is possible to do things with that. So I need to do more research on TOS, but we are in the process of doing that to add a scanner tool to scan through, we'll call it a few hundred stocks to find out which one's the most overvalued or undervalued. Okay, let's go ahead and jump forward here. Excuse me. Okay, we need to focus on entries, trade management, and trade exits. These are the three things we've got to focus on. If we are not prepared for trade management and strategies for how we exit, we're going to be in trouble. So we want quality entries, we want trade management and exits. Look for patterns with price, momentum, and value. That's what we're going to be doing here. Okay, now this is the first strategy I'm going to show you tonight that's been working really well in the markets lately. And this works great in stocks, by the way, futures and Forex. I'll show you an example in gold and also an example in the NASDAQ tonight. Now what I'm doing, I want to look for changes or meaningful changes in momentum. All right, this is step one. So look for higher lows. I'm going to show you what this means on a chart to buy a meaningful change or increase in the strength of momentum on the buy side to buy, or a weakening of momentum on the sell side, okay, in order to get in. I'm going to show you this in the chart, so if you can't picture this in your mind, don't worry about it. Buy, after I have this, okay, I'm looking to buy moderately undervalued, and I'm looking to sell moderately overvalued as my entry. This is where we get into strategic entry, all right? Step number 3 here. I'm looking to risk, in general, 10 to 15 ticks. So you don't have to risk a lot. Obviously, your position size will show, determine how much money you actually end up risking with that. So now ticks mainly relate to Forex and futures. For stocks, you have to look at the volatility of the market, but, it could be something where you're risking 50 cents a contract, or a dollar, or, whatever makes sense. But you'll see in the charts what I'm talking about, or maybe even possibly a lot less in stocks as well. It could be 20 cents. Step 4, move the stop to break even once the opposite value target is hit. I'll show you in a chart exactly what that means. Step number 5, with this strategy, you can actually use a parabolic SAR to exit your position if you like. That's one idea on what you can use to exit your position. Now, I'm showing you a 120-minute chart of gold. Now, for those of you who have heard, from some lectures out there that you can all you need is price action, you don't need indicators, I'm here to tell you that we can run circles around those folks, okay, when it comes to finding strategic entry points. Now, it's not to say that price action traders can't make money. They can. I've seen some good ones out there, and I'm not knocking that. But I am telling you that they're missing opportunities quite often because they don't see opportunities that are forming in the market. So just by looking at an open, high, low, close chart here, you don't see all the different opportunities for trading here. Now, let me throw up some tools here that help us identify some great potential entry points. And this is really, in the last couple of days here in gold, some great entry points, for short positions here in the market. So first, rule number one, we want to see a weakening momentum. Now, this first situation here, I'll call it point number one right here, compared to point A, is that we have our initial upsurge in the price of gold. Now, gold then goes through a consolidation period. Let me get a different color here than red so I can contrast. Okay, I'm going to use point number one right here. Okay, point number one up here. All right, now the gold market prices surge initially, and then they start going through a consolidation. They're resting up. Now the question becomes, what is the follow-on buying strength? Okay, now this is where it gets interesting. Notice this top bar right here is red. So we eclipse the old highs here from point number one, and at the same time, we're significantly overvalued. Okay, that top red color, these are value bars. This is another value charts type tool. The five primary valuation zones are the exact same as I showed you in the value chart. So upper red means significantly overvalued, and we know by our scientific research that markets tend to trade in that region less than 2% of the time. Now, you'll notice this first upsurge here up to point number one, we see some red bars, we see some yellow bars, and there's a value migration happening there. We are not interested in jumping in with a short position there. We want our momentum confirmation at A, and we get this. Now, on a scale of 1 to 10, the momentum confirmation I would say is probably average, so 5, not stellar. Point B and point C have much more powerful momentum confirmations than point A does, but what we do have here with A is we have a significantly overvalued market, and the way to trade this is as soon as you see prices break back down into fair value, which is going from the red bar color, and you can see this in real time, back down to the yellow bar color, that's where you want to sell. So you can literally sell, call it at a price level that's very close to maybe 13.50, and put your stop above 13.15, so about 15 ticks above the highs there. And you can risk that, and you'll notice that if you would have done this, then you're in the driver's seat because you see the market, a couple bars later start to tail off. Your parabolic SAR flips direction, and you could literally ride this thing down if you're using a parabolic SAR to exit right around, call it the 1286.50 level. So you're talking about selling right around 13.13 and covering that around 86. So you're talking about almost, it's a little bit under $30, maybe $25 an ounce, and you risked $1.50 an ounce. Okay, so this is a trade where you might have really never been underwater. So this is how powerful this is. So this initial point right here, again, at the top here, when it goes from the red bar color down to yellow with value bars, you're literally, point number A, get the confirmation, you literally are never losing in that position. I mean, you're almost instantly profitable at the next bar and even in the current bar. And then as you start to see the market sell off, you're in a position where you can put in your break-even stop. So now, one of the steps that we talked about is moving your stop to break-even. So if our stop initially, call it, was above the highs here, I generally say 10 to 15. In this particular case, I might have actually used maybe closer to a 20 tick stop, but right above the highs here, which ended up being very close to 15 ticks, we can actually take that stop as soon as we hit the lower yellow bar cover here in our value bars. So right there at this point I'm pointing to, that's where we can take our stop and move this down to break even. So I'm moving this down to a level, I'm going to put BE right here. So now you have a break-even trade here in gold. You want to be aware that there's no major economic reports coming out because gold can move $40 an ounce with unemployment or other reports, but there weren't any. And so we're now in the driver's seat. We see a sell-off happen. We see the parabolic SAR flip, and then we see things start to go down. Now, it gets better because there's two other great opportunities as well. This is the same indicator that Thomas Wood and Dave Aquino use in their live trading rooms. So they use value bars as well. They use MQ momentum as well, and they can use parabolic SAR. So there's a lot of different trading styles out there. What I'm showing you is one idea. All right, so now we hit our undervalued. We move our stop to break even. Now you'll notice right here that the market pops right back up into moderately overvalued. That's the upper yellow bar segment at point B here. Now, I want you to notice what's happening here with momentum. So look at momentum at point A right here, so right where this arrow is, and now look at your MQ momentum reading at point B. I'm looking at this blue indicator line. This is my MQ momentum. You see a sharp drop off here in the momentum line. So this is telling me momentum is weakening dramatically between both of these points, yet the market pops up to moderately overvalued in the context of weakening momentum. Now, on top of that, there's a great entry here. So just watch this blue line. So in the MQ momentum indicator right here, this has a blue solid indicator line. It has a dashed signal line, and it has a histogram. And then you have this top overvalued and bottom undervalued, plus 25 and negative 25 lines. So essentially what we're looking at in these examples is primarily the indicator line. This blue indicator line, you see it's weakening from A to B, and again, you see it weaken again from point B to point C. And again, when you poke up into moderately overvalued there, another entry point. So you can use these either as initial entries here. These are great initial entry points, or you could use these as pyramid points. Now, I'll tell you that from my 20 years with the hedge fund, there's nothing out there that I know of or that's as can be as strategic with low risk entries as combining momentum, price, and value. So right here, we're showing you literally $1.50 an ounce of risk, for these entry points, and you want to wait for a market to break. You can either just sell right at when it's moderately overvalued here in this example would be, or you can wait for it to break down into fair value. If it does, we call it fair value breakback, at this point or this level right here, that's where you can initiate your trade, and you could put a stop in above the high of the bar at call it 15 to 20 ticks higher, depending on how long, how much room you need to give it to exceed the high of the bar there. And then you can see prices continue to fall off here, and then this last part barely pokes up into moderately overvalued, literally risking probably 5 to 10 ticks there. And again, prices immediately tail off. And then finally, we see prices cross the parabolic SAR right around, we'll call it the 1286 level. So these are, you're ripping off literally 10 to 15 to $25 ounce, profits here with minuscule risk, $1.50, $2 an ounce, or even $1 an ounce risk. Let's get some questions here. Okay. The arrows, let me answer a few questions here. I'll go on. Okay, Mark, could you show this chart in Momentum Trender? Actually, Thomas can do that. If you're using Momentum Trender, this can be a very powerful complement. So, in this case, look at A, for example. If you're using that as your entry point, then you're now looking for selling signals with a tick chart with Momentum Trender, maybe 100 ticks or 250 ticks in gold. So you're drilling down to a shorter time frame and looking for your Momentum Trender sell signals. So I'm not going to go in that today just because I don't have time, but Thomas uses this a lot. Okay, do the arrows just appear on the charts? Yeah, I just actually put these arrows myself. So these are drawn in manually just so you can see the example and where I'm pointing to on this, okay? Why didn't you want to show the peak on 727? Okay, okay, right here, I'm assuming you're talking about this right here. Okay, there's nothing there that tells us there's no changing momentum picture. So we do have a market that's overvalued. It's clearly gone through what I'll call value migration, but there's nothing confirming with momentum. So we're looking for weakening momentum in the context of a short-term overvalued situation. So that's what we're looking for. That's the key there. You want to not just use value, you want to use value and momentum together. Okay, red histogram to be conflicting with the blue lines. The red histogram is not actually in this case conflicting. It's actually supporting that. So let's look at the just briefly. This red histogram down here you'll see is actually weakening as well. But I'm looking at the indicator lines. You can actually use the histogram as well. But right now, in this example, and the examples I'm using tonight, I'm just using the indicator line, which is totally valid. Okay, now you'll notice, this is an interesting question. Notice that the histogram lines for point B, really point B itself, is red in the context of a situation where you're moderately overvalued. This is called a no return setup. It's a great setup to track. All right, very powerful and can be very, very effective as well. You'll notice we had another no return type setup right here with these overvalued price bars. And this is off the screen, so I'm not looking at this first example, but those can be very, very nice setup opportunities. But we're looking at the indicator line, so focus on the indicator line right now, but you can use the histogram under certain situations to find divergences. But in terms of the surges down, it doesn't matter. We don't need the histogram to surge new lows. We just need the indicator line to do that for what we're looking at here. Okay, stopped you when your price. Okay. What is the rule? Okay, aren't you stopped out when the price signals red overvalued? If not, we're looking when the price signals overvalued, and that's a really good question. Let's talk about that. So, right, we're getting in up here on the short side, so we're selling short. For those of you, it's the opposite of buying. We want prices to fall off here and go down. We're going to make money that way. That's when we want to get in and sell short. So we're looking for prices to go down and make money that way. And then another target you could potentially use is significantly undervalued to the downside. So you're literally capturing the profits here between these two entries and exits here, which again is probably about, call it 13 down to, that's about $20 an ounce almost, $18 an ounce here. So you can use that. Don't think of the colors in and of themselves as being meaningful. The colors are meaningful in the context of momentum. They're meaningful in the context of price patterns as well. Okay, so point B, for example, let me see if I can follow up this question. Yeah, this is undervalued. So point B, we're selling overvalued. This is this upper line right here, upper yellow bar segment right here. I'm going to circle it again. That's where we're looking to sell short. All right. If it hits the significantly undervalued lower red, we could exit. And I would not recommend buying there because we don't have a higher low momentum. We've got to have that. All right. So we're not interested in catching a falling knife here. All right. We don't have anything that tells us this market's going to bounce back meaningfully. Now it did. It actually bounced back about $5 an ounce from this moderately undervalued or significantly undervalued state, but that's not a good enough signal for us to take. That's not what I'd advise you to use it for. You could use it for an exit target, but I wouldn't in this particular situation use that as an entry. Let me go ahead and go on to another example here. Let's look at some buy-side entries. Now, gold right here, again, 120s. You'll notice right here you have this point number 1 down here, okay, where you have a low value. Oops, let me go back there. A low value for your MQ momentum line, or looking at the line right here, a low value here, and then it surges up for a higher low. So dramatically increasing momentum line from point 1, which is down here on the chart, to point 2, which is where this green arrow is right here. You'll notice the very low segments of those bars are yellow. So those are yellow, and those are okay for us to buy when they're undervalued. You want to buy in the undervalued bar segment. You don't want to buy after it leaves undervalued. You want to buy it while it's undervalued. Now, in this particular case, we did go up to moderately overvalued in the next bar. Okay, it rallied about, call it $5 an ounce there, but there was no follow through. So what we did is we moved our stop up to break even here, right? And then prices fell back through. So this is actually a break even trade. We didn't lose anything. We didn't make anything. That's okay. We're going to have those. Now, the second example here, again, you see these first points here, momentum at, we'll call it point number 1 here, 2 here. This is 1 here at the ultimate low, 2 here strengthening. All right, this could actually be an entry right there. I missed that. So very bottom tip of that bar is yellow right there. So point number 2 we could have bought there. It's a great point to buy the market. All right, it surged upwards here. We had a value migration. We got into significantly overvalued. And when you see those long red bar segments, that's telling you there's a very strong force pushing the market to a revaluation. And it did. It surged up higher. Gold rallied about $20 an ounce here. And then we see it start to correct again. We have a much higher momentum reading at the solid blue line here at B. We have the green light to buy the lower yellow bar segments in the bars here. and then we have our next surge up here. And then once it hits the upper yellow, we're moving our stops to break even. Again, at point C up here, that very low point of this price bar, we're looking to buy a bottom yellow segment, very low yellow tip. I'm drawing a line pointing to that right now. That's where we're looking to be buyers, because point C on the MQ momentum indicator line is continuing yet again to strengthen. All right, so those are good examples. And then ultimately, here's my rule of thumb. If I get into a trade and it hits significantly overvalued, or a red, value target, I'm out. I generally take my profits and run. So I would have been selling right here, more quickly here with number 2. But if you wanted to there, you could have held on, and you could have actually used the exit up here for parabolic, and that would have gotten you up here. So you got in right down here, call it at maybe 12.89, and then if you held on for parabolic SAR, you're getting out, call it right around 13.11. So, call it about $22 an ounce. Literally, the very low tip of this price bar down here that's not labeled here, I'll put I guess another point A right there. That is extremely low risk there. And again, you have a no return with your green histograms, and you have a strengthening momentum indicator line. I just happened to miss that one in this example. So again, great buying opportunities here. Low risk, buying undervalued with the momentum indicator line strengthening, ultimately getting out at the parabolic SAR cross. So those buy signals worked out fairly well. Let me go on to these few charts examples, and then I'll hit your questions here. So just bear with me here. These are some examples of falling MQ momentum indicator line. You'll see here it's going down, lower high, and then kind of the same level high here. And these are very top tip is moderately overvalued. It's hard to see that, but yellow tip is up there, yellow tip here, and the yellow tip in both of these areas. We could have sold all of those. Okay, now 3 of these 4 trades hit the opposite value target, so we would have moved our stops to break even on 3 of these. One of these trades would have been a loser. So the third arrow right here, I'm circling, the third down arrow, if we're shorting these, all right, selling short these, would have been a loser. All right, the rest of them are break even. That's not bad. We go over here to the right, and we see a really nice setup here. You can see that momentum has fallen off sharply at point E right here. And then you can also see that the histogram bars are red, no return, and the very top tip of this price bar is yellow. That's moderately overvalued in the context of a lower low, or higher, the lower high with your blue, solid blue MQ momentum indicator line. And again, here, interestingly enough, we have a reverse buy signal so that it falls, and then we see it gather itself right here. So you have a strengthening here, and then you have undervalued price bars in the context of that. And then it shoots up to moderately overvalued. So right now we have a break-even situation wherever you end up getting in right there, and then we'll see where this goes. So I think this might even take us up to current today. Is that right? Yeah, I think that's right. So, all right, let me show you a few more examples. I'll get to your questions, just bear with me. Again, just to drive these points home, right here, notice a point 1 here that's not shown right here. Point number 1, you have a nice yellow hat doji. Right, and then you'll see your MQ momentum indicator line falling here. So it's starting to weaken, and then you see the overvalued in the context of that. You hit your break even or your target right here, and moderately undervalued. The lower yellow bar segments right here, right above this white arrow, and then the market rallies up. So this would have been a trade following the rules. We would have been out at even. No harm, no foul. Now, point B here is a great selling opportunity, because you'll notice that you're weakening your MQ momentum indicator line both at point B and point C. So these were the ultimate highs. This is great. So we get in there short, and then we have the market reverse the parabolic SAR, and then right here we can get out if we want to, but we reinitiate another short at point C. And that's nice because we have 2 yellow hat dojis there. And then at point C, so we're profitable in point A to point B. We make a few dollars an ounce. I guess it's $1 an ounce. And then from point C all the way down to the exit point, white arrow down here, we literally have, call it about $7 an ounce, with risking literally maybe 50 cents an ounce, or 70 or $1 an ounce. So this is a 7-to-1 potential reward to risk ratio here. That's exactly what we're looking for. 10-to-1, 20-to-1, 7-to-1. These are the types of trade entries that are very low, oftentimes low risk. Now, strengthening from the low here, we have higher lows in the MQ momentum indicator line. And we have moderately undervalued here. Interestingly, point D does not get stopped out if you use the 15, even 10 to 15 tick rule right here. It would not have been stopped out if you bought undervalued. And then now we're seeing the surge up here. So you hit moderately overvalued here, and then you move your stops up to break even. So worst case scenario with those two buy entries, you're looking at break even. Again here, let me show you a few more examples, and then we'll go to questions. So right here, again, a strengthening from, we'll call this initial point 1 to point A, moderately undervalued, lower yellow bar segments. We're looking to get in a long position there. Now, as soon as we shoot up into the red, this is my significantly overvalued. This is where I like to get out. If it hits significantly overvalued, which is an upper red colored price segment, bar segment, that's where I'm out because the market's really overheated. Sure enough, that ends up being a pretty nice exit. Again, this is a great entry at point B. You have undervalued lower yellow bar segment. You have a strengthening, you can see, of your MQ momentum indicator line. And then this really shoots up well, and you can get out either at significantly overvalued or you can use parabolic SAR there as well. And then you have a selling opportunity here from the top here. We'll put T up there, very top here. And then this next wave up, this is at point C. You can see that weakens in the MQ momentum indicator line. And then you can see that prices sell off. You hit your value target, move your stop down to break even, and then you're looking at a nice situation there. Okay, yeah, let me just go through a few more examples, and then we will take questions. Again, these are a few examples just looking at the lower arrows here, the strengthening of your MQ momentum indicator line, buying in the context undervalued there. We're looking at some nice profits here in NASDAQ. Taking profits here of, call it 5 points in the second trade, break even the first trade, and then if you could have sold this trade right here, but this would have actually been a losing trade because you never hit your undervalued target here to move your stop down to break even. So the market actually moves up, stops us out on a losing trade here, but then you have some really nice sell signals at point C, at point D, and I'm sorry, yeah, C and D here. There's 2 points at D, going all the way down to your parabolic SAR exit. So again, some nice buy signals here. So strengthening right here with your momentum line. You have undervalued right there, very low tip of that bar, very low tips of these two bars at point E and point F, and then a really nice surge upwards. So you're looking at buying right around, call it the 38.87 or 8 level, eventually getting out right at, call it the 39.03 level. So not a bad deal there. Taking out, call it maybe 15, 20, 15, 18 points in NASDAQ, and literally you're risking less than probably 2 points, and that's about $40 a contract. You're trading the NASDAQ futures. So $40 a contract to make $200 or $300 is not a bad trade-off. Okay, next strategy. I'm going to go through this briefly. This is just 2 slides here. For this, you want to look for the MQ trend direction. This is another way to trade markets. If you have a strong opinion about a move that could be coming up in a market, use the MQ trend to establish the intraday short-term trend direction, and then you want to buy moderately undervalued for an uptrend or sell moderately undervalued for a downtrend. Place a stop below your MQ trend line. You can move your stops up as the trend line. The MQ trend line moves up. Only pyramid with higher entries, and then you want to exit when the MQ trend indicator changes direction, essentially. Now, this is just a slide to show you that 5-bar analysis period for value charts, in my mind, is a little bit too aggressive. I would use a longer term setting there. So what I prefer here is the 10-bar analysis period. And I'm using the value flags to actually plot purple dots below the lows of price bars where we'd be looking to buy. So right there, the bottom yellow segments is where we're looking to be a buyer. Now, the MQ trend indicator are these dots that are being plotted below the price bars, and when they're green and below, this indicates an uptrend, all right? And this is what we saw today in the NASDAQ. So when you see that happen, this is a trend short-term using 500 tick bars here, uptrend intraday. We're looking to take advantage of this, all right, and possibly even pyramid on our position. And then what we want to do is we want to use this change of trend. So you'll notice right here we changed from a red MQ trend line to our indicator line to a green. So went from downtrend to uptrend. When this green line turns back down to red, then we want to reverse or get out of our long position. So we're trading in the direction of the MQ trend again, which is these dots, these green dots being plotted below prices, and we're buying undervalued, which is the lower yellow bar segments. We're really not even using the momentum, MQ momentum or the MQ cycle finder below, but you can potentially use these indicators to confirm a stronger setup here, even intraday. So if you see a stronger signal here with these indicators, this could possibly cause you to increase your weighting, maybe on a pyramid, or even only take the pyramid when you have a confirming signal with your MQ trend or MQ momentum or MQ cycle finder. All right, let me just take a few questions. Okay, I see Dave take a lot or has a lot of indicators in addition to value ones like squeeze or voodoo lines. How do these work together? Also, differences in TOS and TradeStation. A TradeStation TOS should look very similar in terms of the tools I'm showing you here. Now, every trader, this is what I challenge you. I challenged Thomas and Dave to do the same thing, and they're doing this. That is, you want to use your own flavor of everything we're talking about. So you get the core principles of using momentum, price, and value, and then what you want to do is put your own style in there. So a lot of traders that we have as members of ValueCharts.com are using their own unique way of approaching this. So Dave will use, he could use the squeeze indicator to find, a low vol, compression environment to an explosion environment where you're seeing a volatility breakout. So it's possible and certainly encouraging. I would encourage you to experiment with different things. I'm just showing you some of my favorite ways to trade these indicators. And they should appear very similar on the TOS and the TradeStation platform. What is the setting for your value bars? Scott, all my settings tonight were 5, except for the last slide here, I'm using 10. So all of them were 5 otherwise. Okay, no more time, explanation of no returns. Oh yeah, Sam, explanation of no returns, all that is, let me go back a slide here and I'll show you exactly what that is. So no return is, here's a great example. That is a very powerful setup, by the way. I'm going to change my, actually, I'll just leave my in color same. So right here, notice at point E and point F, I have lower yellow bar segments, moderately undervalued according to value bars. And notice down here with my histogram on the MQ momentum indicator, that's positive green. So when you have a positive green histogram in the context of a undervalued, value charts or value bars reading, that's what's called a no return. Those can be exceptionally great, entry signals. Very often, very low risk. So those can be great. So I'll go into more detail on those in the future workshops and webinars. What is your value bar on your 120 chart? 5. Robert, I'm using 5 for that setting, for all the 120 settings. Good question, though. Okay, no sound. Okay, hopefully everybody can hear me, right? If you want to just type in a yes, I'm hoping I'm not talking to myself. I think people would have said something before now. Okay, good. Okay, it's MQ trend setting 10. Okay, MQ trend setting, let me show you what that is. Okay, I'm sorry, just a second here. All right, I'm going back here. Let me fast forward. Okay, so for the MQ trend, I'm using the standard settings, which are, the main one you want to look at is the ATR setting, and that is not the length, but the ATR multiplier, and that's 4. For intraday, I set that to 4. I believe the length and the ATR length are both 21, so I didn't change that. Now, the ATR multiplier I use for, if it's daily bars I'm tracking with the MQ trend, I use the setting of 3. But for intraday, I always use 4. Okay, what is the trigger for shorts? Well, everything I showed you tonight, find the lower highs, again, and here's a nice one here that we're uncovering. I'll show you. So right here, you have a lower high of your MQ momentum indicator line, and then right here, you have a golden doji, very top pattern right there. So you could have potentially sold short there and put your stop above the high. It eventually corrects down undervalued. You could have moved your stop to break even. Having said that, in the way we're teaching here, we're not fading the trend. We're actually only buying in the general direction of the MQ trend. But essentially, that's what, for short signals, you're wanting to see a weakening of your, MQ value, MQ momentum indicator line and lower highs in that for your for your trend direction. Now, I like to use time bars for my setups, and I like to use tick bars a lot of times for my signals. You can use 120-minute bars like we showed you before for both. You can use those for both, but sometimes the 240s and the 120s are great for setups, and then you can drill down to your tick bars to actually time your entry. Okay, on the buy side, when you buy yellow, you buy when yellow turns to green. You can buy it when it's yellow, Sam. You don't need to wait until it turns to green, or while still yellow. So you can buy it while it's still yellow. You don't need to wait until it turns green. The first example where I had new highs in the market and it was significantly overvalued, that's really the main one where you want to buy the breakback into moderately undervalued. In general, though, I usually try to buy it when it's in the yellow period for all the other examples, and I'm willing to take the risk. And then again, I'm using, in general, maybe 10 to 15 ticks on both the NASDAQ futures contract and the gold contract as well. Now, a lot of you have been asking, Mark, you've disappeared for a while, I've been doing other research and stuff, but what I'm going to do is present a workshop next week. This is reduced in price for our members and really for everybody here tonight. This is a $97 workshop. If you're interested in learning more about what we talked about tonight, I'm going to introduce another new indicator as well that I think is very powerful. But what I'm going to do is kind of a 2-hour, it's going to be a boot camp. We're going to blast through this stuff, forecasting market outlooks. We're going to talk about daily high probability setups, so going from soup to nuts. And we're going to talk about 3 top value candlestick patterns I look for, timing intraday entries, other strategies for break-even stop movement, and then trading position control transfer techniques. It's a mouthful. Now, the reason why I'm going to talk about that is because we may be looking at some incredible opportunities that are coming up in the markets here. So I'm going to go ahead. Let me just go ahead and post this link. Go to Value Charts down here at the bottom, valuechartstrading.com/Mark if you want to participate. Again, it's only $97, and I'm very confident that you will find it well worth it. As always, if you don't find it worth your time, then call us up and we'll give you a refund. So I generally try to deliver much more content than we ever charge for, and hopefully you'll be satisfied. But come join me. It's drill down entries, transforming intraday setups into huge winners. Now, the additional information that we're going to talk about here is how do you convert that strategic entry point in the day? How do you tie that into a longer-term home run style trade? So how do you risk, that really small risk when you think there's a market that has the potential on a longer-term basis to move dramatically in one direction? I'm going to show you how to do that, and it's possible to do that. So if you're interested, again, come to the workshop here, and I'm going to talk about all those points. I'm going to pack it in. It is recorded, and we're limiting the seats to 100 seats. So if for some reason you get locked out, we may have a second one. But try to join us. I try to limit the attendees so we can take Q&A, and we're not overwhelmed by that. But again, I think it's going to be great tools, and this will be really nice, strategies, powerful strategies that are going to prepare us for a lot of the potential fireworks that are heading our direction, especially in the stock market as we come into the fall. So very interesting things developing there. Okay, will you assist in setting up the charts? Yeah, I will talk about how to set up all the tools. We'll go through that. I'll start with a blank chart and then talk about here's how you add the value charts, here are the settings for value charts, value bars, and etc. Okay, Sam, I bought value charts. Can I exchange for value bars? Value bars they're not split out from the mega bundle yet, but we're considering doing that. That's actually a separate indicator, Sam, but we'll probably be having a special value bars here in the not too distant future. That's not a separate indicator sale at this point, but we'll keep you posted, or just stay tuned, because that may be something that's offered for sale here as well. Now, value charts are still very powerful. Value charts are a great indicator I'd recommend you hold on to, because they actually have a momentum component that can do some things that we didn't touch on tonight. Okay, the upcoming class is for which indicators? Good question. Now, the class that I'm teaching is going to include all the same indicators we talked about tonight. All right, now, if you say, Mark, I don't have these indicators, well, at least here's what I can guarantee you. We'll offer you a promotional deal. If you're interested in just putting your toe in the water to get value charts and possibly even value bars, I'll offer you a promotional deal for those, but and also for a bundle if you're interested in looking at the bundles. Now, if you don't have the indicators and you're not interested in buying them, I would still strongly suggest that you come, because you're going to take some great information away from this that you can potentially use with possible, substitute indicators. There's nothing out there quite like value charts, so it's going to be more difficult to find that. But value charts, you can get itself the indicator for a, you can get that for $97 by itself if you're interested. But this is not promoting our indicators. This is showing you very powerful trading ideas that we've designed from our custom indicators. All right, so yeah, it does work with our proprietary technology, but you can get into this. You can use a substitute for MQ Momentum, like MACD works really well for that. So you don't need to make a sizable investment to take advantage of this. Now, price for value charts is $97. That actually is split out from the bundle. You can take advantage of that. Contact customer service if you're interested in that. We'll send you a lead on that. Okay, how fast do you need your stop entry to move your stop entry? Okay, how fast do you need to do your stop entry after entry? To do your stop, doesn't have to be a huge hurry. Kara, you can move that, you can put that on the market like you normally do. I always believe that you put your stop loss in there as quickly as possible, but just normal speed usually will cover it. If you're in a fast market situation right after an announcement, be very careful because the market can move very quickly. You want to make sure if you're trading in that environment, you have the ability to put your stop in very quickly. Okay, will Thomas be joining you in this class? I asked because I think he mentioned some courses. Yeah, Scott, I don't. I'll ask Thomas if he can pop in. That might be worth it to get his perspective on some of this. But we will definitely have. We're going to have a really neat class coming up. It's called. It's really our favorite trades class, and it's going to be featuring a number of different traders. And it's going to be like a 4-hour deal. That's going to be really cool. Talking real live. What are our favorite trades? What are the best markets, best trades that we love ourselves? And interestingly enough, we all have our different flavor. So Thomas will speak. I'll speak. Good chance Hubert will join us as well in that, and then and Dave Aquino will as well. And heck, it'd be great to have Drew there as well. So we'll have 4 to 5 speakers there, and that's upcoming pretty soon as well. So stay tuned for that. More info on the indicator you mentioned, Rodney. Value bars is go to our website, go to valuecharts.com, and check out our indicator bundles there. There's a big description for each one of the indicators that should hopefully give you most of what you want to know with respect to the indicators. Again, if you're interested in joining this workshop coming up next week, it is recorded, so you don't have to actually physically be there, but go to www.valuechartstrading.com/Mark. All right, so $97 is the price, yes, for the workshop. So let me go ahead and display this for everybody to see. The link again. Is the MQ not included with the value charts? No, they're different. There's different indicators, but they'll be broken out. I think MQ Momentum will be broken out here as well. We've primarily sold them in bundles because we found most people end up wanting the bundles anyways, but we do have promotional specials that do happen, and that MQ Momentum itself will probably be available by itself in the next couple of maybe 2 to 3 months at the worst case. But a substitute for that until you get that could be the MACD. Okay, I have smart momentum indicators. Is this value chart quite comparable? Smart momentum indicator. I'm not sure. Value charts is actually different than that. I'm not sure exactly what you're referring to on that, but value charts itself is unique. It's patented, so I know it's unique. Is value bar indicator one that paints the bars? Yes, Raymond. Value bars is the one that paints the different bar colors. Let me see here. In fact, I'll go back to the previous slide here. So value bars, yeah, is the overlay on top of the open, high, low, closed bars that turns them green, yellow, or red. That's what we call value bars. Okay. Next question. Did you say something about a new indicator? Yes, Jim. At this workshop, I'm going to be showing you a new cool indicator that assists in finding the identifying the changes in, or what we're looking at with the kind of the confirming momentum activity. It's called MQ momentum change. So I'll show you that as well. Okay, I meant what you said. Introducing, yeah, I'll be introducing new indicator. I'm sorry, yes, Rodney, I will be on that, and probably I'll show you everybody how to get a hold of it. It may be something you're interested in using. Maybe something that you may not be interested. I might even try, now don't hold me to this, okay, because I've got a fairly hectic schedule, but I might try to make a counterpart for TradeStation at least for the MACD. So for those of you who attend the workshop, if you're interested in the new indicator counterpart, which is kind of a close second, if you will, I'll try to make a free version of that with MACD available. I can't promise that. I think you'll definitely benefit from the class without receiving that, but let me try to do that. Okay, I bought MQ Trender. Okay, Momentum Trender. Okay, to be used with the Momentum Trender. Okay, if I buy the bundle, will I? Those are Julie. Yeah, give us a call at customer service, and we can definitely tell you any of the promotions we've got going on that. We do have member promotions that we do offer. So give us a call at go to valuecharts.com. In the bottom left-hand corner is our telephone number, or below it. Yeah, on the slide right here. So I don't know if somebody's there right now, but they may be on the line. We're having quite a few people call in. Okay, are your value flags? Yeah, value flags are also set at 10 there, Scott, for the last slide. So they're set at the exact same setting that the value bars are. So as soon as they hit -4 or below, the value bars do, our value charts does, then the value flag appears. Does the value bars work on any platform? Fred, value bars work on TradeStation, NinjaTrader, Thinkorswim Toss, eSignal, Sierra Charts, and Multicharts. Does the indicator work on any platform? I think I just got that one. Does the ultimate value bundle include value bars? It does. So if you're serious about trading, by all means, I would recommend buying the ultimate bundle. It has everything you want. All indicators are included, and at least for me, I'm looking to usually risk more than $1,000 a day in trading, and spending $1,000 or $1,500 for indicators is it's a no-brainer. So for me at least, and I think for any serious traders that are trading a sizable account. MetaTrader, yes. No, MetaTrader, we're coming out with, Mark. So stay tuned for that. We are building our tools out for MT4, so that should be coming out in the next couple of weeks, hopefully. Does value bars work with candlesticks? Now, interesting question, Jay. Value bars, you have to understand what candlesticks are doing conceptually. So the graphics capabilities of most platforms do not allow value bars to be overlaid on top of candles. So the answer is no, but if you learn how to read candlesticks through the open, high, low, close bars, you can actually infer the candlestick patterns. We actually we're the first company in the world that'll be creating value candles here at some point, but the only reason why we don't have them is because none of the platforms out there have the graphic capabilities to generate those. But those are coming in the near future, Jay, so stay tuned for those. Value candles are awesome, but you can take advantage by inferring the candle patterns by using value bars. There's a way to do that. We can actually, in fact, if you're interested in seeing a course on that, we can go over a course on that and maybe even have a workshop just dedicated to how you do that. Free workshop coming up. Okay, will the new indicators be included for, yes, if you have the ultimate bundle, a purchase, George, yeah, we're gonna include that. So you won't have to buy that. So just contact us and we'll get you fixed up. Are your new indicators compatible with the latest version of TradeStation? Yes, they are. The new indicator I already have value charts bundle and MQ bundle is that, yeah, you'll get that, Mike. Just contact us. So yeah, you don't have to buy anything else. If you already have the value charts and MQ bundle, then you have everything. So the new indicator will be included. The only caveat here, and this is where I get in trouble with my developers all the time, I don't know how long it'll take us to build it out, but I will have it for TradeStation immediately. But if you have a different platform, just bear with us. NinjaTrader and Toss, we should be able to build up in relatively short order for that. Trade Navigator, we have not built our tools out, but if you're interested, let us know. We can check into that and see if we have enough requests. We can certainly consider that. Ultimate bundle right now is, I think, $14.99, I believe. So check our website. And then give us a call at customer service and see if there's any promotions being offered for that. There could, Fred. I guess who's asking a question on that? Ultimate bundle. Yeah, Tariq, give us a call and we could definitely see if there's a promotion for that as well. Ultimate bundle is what? Okay, is what have how many new indicators? Okay, if you have, Mark, if you have the ultimate bundle, I think you've got everything. So the one indicator, there may be, I don't think there's anything that you don't have, but I can check. I'm just going from memory there, but this new indicator will be something new. That's something we're going to be adding on there. So if you have TradeStation, then you'll be able to have, I would think, very quick access to that. I'll try to have it even available next week for TradeStation and possibly for some of the other platforms as well. Okay, well, I have once again exceeded my time, and I apologize for doing that. I hope to see a lot of you folks at this workshop. Again, it's $97. If you're like me, that's a hair above what you pay for a tank of gas these days, which is crazy. And I hope to give you a lot more value in that than just the $97. And I'd like to spend a little bit of time there too, taking Q&A. It will be recorded, so hopefully everybody will benefit. Now, let me tell you this. The things I'm showing you tonight, I've been a researcher for award-winning hedge funds for 20 years. The stuff I'm showed you tonight, I'm going to show you in this workshop, are among the most powerful strategies on the market, all right, for low-risk trade entries. If you hone your skills down, if you do nothing but fine-tune your skills with what I'm showing you, I believe that you can get to the point where you get very good at your trade entries, and you'll find that you have a lot of very exciting and interesting possibilities in how you trade the markets. Thank you, everybody, for your nice words and compliments tonight. Let's see here. Making sure I haven't missed a question here. What is the name of the new indicator? It's going to be called the MQ Momentum Change. What is the name of the new bundle? No new bundle, same bundles. If you have the bundle already, you get the indicator for free. So I've got to figure out how to handle this if people just want to buy the indicator by itself. But in general, again, it's small potatoes. We'll fix you up. So more importantly, learn the stuff that I'll be presenting, and it's going to open up some interesting possibilities for you if you haven't used this stuff before. If you don't have value charts, if you haven't, you don't have the MQ trading tools, again, if you're not satisfied with the workshop, give us a call. We'll give you your money back. But I believe it's going to get you to think about some new and powerful ways to trade the markets, and it's going to show you why these tools, I believe, are required equipment for your trading toolbox and can be extremely powerful in helping identify those low-risk trade entries. Avery, thank you. And Mark, thank you. George, appreciate it. Raymond, thank you. Let's see here. And then, okay, the new momentum change, is it similar to momentum trender? No, it's actually different. It's a different concept. So, yeah, momentum trender is unique. That's a momentum change is more of a setup tool. Momentum trender is more of actually a trading tool. Okay. Avery, thank you. Hossein, I don't know if I'm pronouncing that right, but thank you as well. And everybody, thanks for coming out tonight. Appreciate you spending time and joining me tonight. Again, looking forward to many of you who sign up tonight for the workshop next week. We'll have more free webinars, so stay tuned for those upcoming. A lot of really cool ones with some new types of strategies coming up that we've been looking at the markets. And we're going to show you a lot of the stuff in future workshops here about what's really been working well in the markets as of late. So stay tuned for that as well. And if you're not a member of ValueCharts.com, come out and join us. We have 2 live trading rooms that operate every day, and we trade futures and Forex in one. We trade stocks and stock options in the other. So our trading rooms are among the best in the world. We have 2 professional traders that are legitimately professional traders who are among the best out there in doing what they do. And they're great teachers of our concepts and their concepts, and they're great guys, very friendly, and just good people. So they're interested in helping you become a better trader and teaching you some powerful ways to trade the markets. Okay, I love Thomas's trading room. Julie, you're not the only one. Thomas is great. Dave's great as well. Any Forex strategies, Mark, everything I'm showing you is legit Forex. All this stuff works great in Forex as well. In fact, I'll try to use some Forex examples in the workshop next week. So come out and join me, and you'll hopefully see some of those as well. And stock examples as well if you trade stocks. Okay, well, Mark, thank you. And everybody else, thank you for coming tonight. I'm going to go ahead and shut her down. We do have this recorded. Have a great evening and good luck trading. And for all of our members out there, looking forward to seeing you tomorrow in the live trading rooms. Have a great evening.